SCHD is often called a dividend investor's best friend, and for good reason. Over the past decade, it has delivered solid returns and become a staple in countless portfolios. But here's the thing. While SCHD has averaged about 11% a year, several lesser-known ETFs have quietly outpaced it, with some delivering nearly double that return annually. If you're sticking with SCHD just because it's popular, you might be missing out on even greater growth. Are you relying on a strategy that hasn't kept up with the way the market is changing? Let's see if SCHD really is the smartest move for investors today. For many investors, SCHD has been the default pick for steady dividend income. Its reputation is built on years of dependable performance, a low 0.06% expense ratio, and a portfolio concentrated in sectors like financials, consumer staples, and healthcare. These features have made it a classic choice for those seeking stability and a reliable source of income. With a 4.03% dividend yield and 13 years of consecutive dividend growth, SCHD's strengths are clear. But as the market landscape shifts, it's worth asking whether SCHD's strengths align with the new realities investors face. One of SCHD's defining traits is the focus on value stock with strong fundamentals. This approach has helped it weather market downturns and deliver consistent returns. However, it also means SCHD has limited exposure to technology, the sector that has powered much of the market's growth over the past decade. While SCHD does include some tech companies, its allocation is modest compared to newer ETFs like FDV, where technology makes up about half of the portfolio. Other competitors such as DIVBB have also shifted to include more growth-oriented companies that not only pay dividends but also engage in aggressive share buybacks, further boosting shareholder value. The numbers paint a stark picture. Over the past 5 years, SCHD's annualized return stands at 11.73%. That's solid, especially for a fund prioritizing income and stability. But DIVBB, which combines dividends and paybacks, has posted a 5-year annual return of 18.98%. FDV, with its heavier tech tilt, has delivered 20.58%. These aren't small differences. They represent a significant gap in potential growth. The market shift towards technology and companies that return capital through both dividends and buybacks has left traditional value-focused funds like SCHD trailing behind. This isn't just about chasing higher numbers. The market has changed. Technology companies now drive a large share of overall gains and strategies' volatility. It's about opportunity cost. Investors who only focus on traditional dividend payers may find their portfolios lagging as the market increasingly favors companies with both strong growth prospects and shareholder-friendly policies like buybacks. That said, SCHD hasn't lost its appeal for everyone. Its 4.03% yield and exposure to blue-chip companies make it a dependable option for retirees or anyone who prioritizes predictable cash flow over aggressive growth. There's a clear comfort in knowing your investments are in established, financially sound businesses. But for those looking to maximize returns in a market shaped by rapid innovation and evolving shareholder strategies, SCHD's conservative approach may no longer be enough. The evolution of dividend investing is clear in the rise of ETFs like DIVB, which not only maintains a focus on steady income, but also incorporate buybacks to amplify shareholder returns. This approach adapts to the realities of a market where growth and income can go hand in hand. If you're open to exploring options that blend the best of both worlds, dividends and growth, there are compelling alternatives on the table. So, what does this new breed of ETF look like in practice? Let's take a closer look at DIVB, a fund that quietly combines strong dividends with the added benefit of buybacks, offering a different path for investors who want more than just traditional income. Enter the iShares Core Dividend ETF, or DIVB. A fund that's quietly redefining what it means to invest in both income and growth. Unlike traditional dividend ETFs, DIVBB targets companies that not only pay dividends, but also actively buy back their own shares. This dual approach is a key reason why DIVB has stood out, especially as more companies look for ways to reward shareholders beyond just quarterly payouts. Buybacks matter because they reduce the number of shares available in the market, which can increase earnings per share and potentially lift stock prices. For investors, this means the benefits go beyond just collecting dividends. You're also positioned to benefit from rising share values as companies signal confidence in their future. Over the last several years, buybacks have become a major lever for shareholders' returns, and DIVB's strategy is built to capture this trend alongside steady dividend income. Looking at DIVB's portfolio, you'll find impressive diversification with 413 stocks. The fund spreads its risk across many sectors, but it's particularly strong in technology and financials, two areas that have driven much of the market's recent growth. Top holdings like Cisco Systems, IBM, and JP Morgan Chase demonstrate how DIVB balances stability with the potential for upside. Cisco is known for consistent dividends and a history of buybacks. IBM is navigating a tech transformation while rewarding shareholders, and JP Morgan blends capital growth with regular income. This mix gives DIVB a unique edge compared to funds that stick strictly to value or income plays. When you stack up the numbers, the appeal becomes even clearer. DIVB has delivered a 5-year annualized return of roughly 18.98%, outpacing SCHD's 11.73% over the same period. That's a meaningful difference, and it highlights how combining buybacks with dividends can lead to stronger performance, especially in a market that increasingly rewards companies for returning capital to shareholders in multiple ways. DIVB's emphasis on technology and financials also means you're not missing out on sectors that are shaping the future while still collecting reliable income. Another key reason investors pay attention to DIVB is the accelerating dividend growth. Over the last 5 years, DIVB's annual dividend growth rate has hit 15.12%. For shareholders, this isn't just a number. It's a sign that your income stream could grow significantly over time, helping to keep pace with inflation and increasing your total returns. An ETF that can boost its payouts at this rate stands out, especially for anyone focused on building wealth for the long term. Cost is another area where DIVB shines. With an expense ratio of just 0.05%, it's one of the most affordable options in the space. Low cost means more of your money stays invested and working for you, which can make a big difference as returns compound. Combine that with a 12-month trailing yield of 2.80% and you have a fund that's not just focused on growth, but also on delivering consistent, tangible income. DIVB's approach is all about flexibility. By targeting companies that excel at both dividends and buybacks, and by maintaining strong exposure to growth sectors like technology, the fund adapts to the changing market landscape. For investors who want more than just the traditional value or income play, DIVB offers a way to participate in both market growth and rising shareholder payouts. But what if you want to take that growth focus even further, especially in the tech sector? There's another ETF that's capturing attention by putting technology front and center while still delivering a solid stream of dividends. Imagine harnessing the power of tech giants and their market-beating growth all while collecting regular income. That's what FDV is all about. When you look at the Fidelity High Dividend ETF or FDV, you see a fund that takes a different path from most traditional dividend ETFs. Instead of focusing only on high current yields or defensive sectors, FDV zeroes in on large and mid-cap companies that not only pay dividends, but are also expected to keep growing them. The real difference, though, is its significant allocation to the technology sector. A move that has changed the game for dividend investors seeking more than just steady income. FDV's portfolio is built around a select group of industry leaders in a single fast-paced lineup. Apple, Microsoft, and Nvidia drive both innovation and returns while also delivering consistent dividend growth. These companies are at the forefront of global tech, and their inclusion means FDV gives you access to the same forces that have propelled the stock market's biggest gains. Apple continues to raise its dividend supported by huge cash reserves. Microsoft pairs dependable payouts with aggressive increases. And Nvidia, known for its rapid growth in AI and graphics, adds capital appreciation to the mix. Alongside tech, FDV balances its portfolio with financial titans like JP Morgan Chase and Visa, bringing stability and diversification without losing its growth edge. Can a dividend ETF outpace major growth funds? FDV's performance over the past 5 years answers that question. The fund has delivered a 20.58% annual return, far outstripping SCHD's 11.73% in the same period. This isn't just a small difference. It's a gap that highlights the impact of combining dividend growth with exposure to the fastest-growing sectors. FDV's 3.22% yield might seem moderate at first, but paired with high capital appreciation, it becomes a compelling option for investors who want both income and growth. The fund's 5-year compounded annual dividend growth rate of 4.5% further supports its approach, showing that the companies inside aren't just paying dividends, they're raising them consistently, which helps your income keep up over time. The concentrated nature of FDV's holdings is a double-edged sword. By focusing on fewer stocks, the fund increases your potential upside if those companies perform well. But it also means greater downside risk if any of its top holdings stumble. For investors, this trade-off is important to recognize. While FDV's approach can lead to higher returns, it comes with the reality that you're more exposed to the fortunes of its biggest positions. Still, the fund's inclusion of strong financial companies and its careful stock selection helps manage that risk, offering a balance that many traditional dividend ETFs don't provide. On the cost side, FDV remains competitive. Its 0.16% expense ratio reflects the active management and careful curation of its portfolio. You pay $16 a year for every $10,000 invested, which is reasonable considering the potential for both capital growth and rising dividends. For many investors, this small premium is justified by the fund's performance and the unique blend of tech-driven growth and steady income. FDV's strategy is built for a market where technology continues to dominate. Over the last decade, tech companies have led market growth, and FDV's heavy allocation to this sector positions it to benefit if that trend continues. Unlike more traditional dividend funds that stick to value stocks in sectors like industrials or consumer staples, FDV opens the door to a different kind of opportunity. It shows that you don't have to choose between growth and dividends. You can have both as long as you're willing to accept a bit more risk for the chance at higher returns. For investors who want to capture innovation, rising income, and the market's biggest growth stories, FDV stands out as a strong alternative to older value-focused funds. But not everyone is looking for tech-driven upside alone. Some investors want a strategy built on steady, long-term dividend growth. A way to build wealth through companies that increase their payouts year after year, regardless of sector trends. For investors who prefer a disciplined, evidence-based approach to building wealth, DGRO and VIG stand out as two of the most respected names in the dividend growth space. These ETFs are designed for those who want to capture the power of compounding by focusing on companies with a history of increasing dividends. DGRO, the iShares Core Dividend Growth ETF, and VIG, the Vanguard Dividend Appreciation ETF, each take a slightly different path, but share a commitment to quality and consistency. DGRO offers impressive diversification, holding 417 stocks across a wide range of industries. This broad exposure means you're not overly reliant on any single sector or company, helping to manage risk while still capturing growth. VIG, on the other hand, is a bit more selective with 338 holdings chosen from their consistent record of annual dividend growth. Both funds are built to weather market ups and downs by leaning on companies that have proven they can reward shareholders through thick and thin. What sets these funds apart is their focus on both current income and future growth. DGRO's 2.33% yield paired with a 7.61% 5-year annual dividend growth rate gives you a steady stream of income that's likely to keep rising over time. VIG, meanwhile, offers a 1.88% yield, but compensates with a faster 11.33% 5-year dividend growth rate. This difference highlights a key trade-off. DGRO provides a higher initial payout, while VIG's quicker dividend growth means your income could increase more rapidly in the years ahead. For investors, the choice comes down to priorities. Those seeking a broad market foundation with reliable income may gravitate towards DGRRO, while those focused on maximizing long-term dividend growth might find VIG a better fit. The makeup of these funds reflect their strategies. DGRO's top holdings include Microsoft, JP Morgan Chase, and Apple. Companies that combine financial strength with a record of rewarding shareholders. VIG also counts Apple and Microsoft among its largest positions, but adds names like Broadcom and Eli Lilly, capturing leadership in both technology and healthcare. These holdings are not just well-known, they're industry leaders that have demonstrated resilience and a commitment to growing dividends, even in challenging times. Performance numbers reinforce the value of this approach. DGRO has delivered a 16.26% 26% annualized return over the past 5 years with a 10-year return of 11.56%. VIG has posted a 15.58% average annual return over 5 years and topped 11% over the past decade. These results show that focusing on companies with a proven ability to grow dividends can lead to both stability and strong long-term gains. Reinvesting those growing dividends can further accelerate wealth accumulation, making these funds especially attractive for patient investors. Cost efficiency is another advantage. DGRO's expense ratio is just 0.08%, while VIG's is even lower at 0.05%. These low fees mean that more of your returns stay in your pocket, and over years or decades the difference adds up. For long-term investors, minimizing costs is a crucial part of maximizing total returns. Sector allocation gives each fund its own flavor. VIG leans into technology and financials, with healthcare as another major component. This positioning allows it to capture growth from sectors driving economic change while still maintaining dividend discipline. DGRO takes a more balanced approach, blending exposure to innovative industries with more traditional stable sectors. This balance can provide a buffer when markets are volatile, offering a smoother ride for investors who value consistency. If you're looking for a fund to serve as a portfolio cornerstone, both DGRO and VIG fit the bill. DGRO suits broad market builders who want reliable income and diversification, while VIG is ideal for growth-oriented dividend architects seeking to maximize future payouts. Both funds reward patience and a long-term mindset, offering a way to steadily grow wealth without chasing the highest yields or the hottest trends. Their real strength lies in their ability to adapt to shifting market conditions while maintaining a disciplined focus on dividend growth. By prioritizing companies with a track record of increasing payouts, these ETFs reduce much of the uncertainty that comes with more speculative strategies. In an investing landscape that's always evolving, that kind of reliability can be a valuable asset. As you consider how to position your portfolio for the future, it's worth asking whether your current approach is keeping up with the market's evolution. The landscape of dividend investing has changed, and the right mix of ETFs can help you capture both stability and growth as you work towards your financial goals. As you think about the next steps for your portfolio, it's clear that relying only on SCHD could mean missing out on opportunities. The current market, shaped by rapid innovation and shifting sector leadership, calls for a more balanced approach. Consider how FDV brings tech power. DIVB adds buyback to the mix, and DGRO offers broad dividend growth. Each ETF has a distinct strength that can help you match your investments to your goals and risk tolerance. Let us know in the comments which ETF stood out for you. And if this comparison helped, don't forget to like and subscribe for more insights.